Good morning and welcome to True Options Masters monthly market outlook for October. How did that happen? How are we already in Q4 of 2021, guys? I don't understand that at all, but here we are nevertheless. So before we get this thing started, we are knocking on the door for True Options Masters of 80,000 subscribers. So thank you to everybody who subscribed. Our goal is to hit 100,000 readers by the end of the year. We're well on track to do that. So if you're liking True Options Masters, please tell your friends, tell your family, tell your loved ones. We want everyone to be reading and we really appreciate it. And if you like this video, please like, comment, and subscribe to our YouTube channel so we can get this content out to more and more people. So Mike, Chad, welcome. Before we get this thing kicked off, Mike, we're recording this on Friday, October 1st, because on Monday and Tuesday, you've got something special going on. What are you up to next week?
Monday and Tuesday, I will be teaching the New York Institute of Finance class on technical analysis. And I guess we can get a critique of how well I teach. Chris, I think you've been to the class, Chris.
I think I have been to that class. What was it, maybe a couple of years ago? Yeah, great class. You covered basically every major technical indicator known to man. And you talked a little bit about the differences between systems and discretionary traders. And I think that's when I first realized that I myself am not a systems trader because I don't like rules. I like breaking rules. Unlike you two fine gentlemen who like to stick to your parameters and not do crazy, silly things like me that are probably more risky than necessary. But good luck with that class, Mike. I think that class costs, what is it, $1,600?
I think it's 1,800.
It's 18. Oh, inflation is real. Inflation is definitely
it's 2
real.
days.
Yeah. That's that class is no joke though. It's the real thing. And Chad, we got something special coming up for you this month. I think we are launching your new service, Fast Lane Profits, finally. Chad, you want to tell our readers why you're so excited about Fast Lane Profits? I know I am.
Yeah, I mean, it's our latest service, but I mean, it's based a lot on kind of what I'm showing you today on the relative rotation graph, but we take a totally different approach to it to really pick. I mean, it's called Fast Lane Profits because we're trying to find the fast lane in the market, which is basically the index that's going to move the fastest over the next few days. So I'm excited to roll that out here in the coming weeks and tell you a lot more about it.
Gotcha. Yeah, we've been beta testing and back testing that strategy all year. And we even had these numbers verified by our legal team, and your average trade in about 6 months of beta testing was over 20%. And the average trade took 5 days, I think. That's pretty killer, Chad. And I think that's the advantage of being able to determine what the fast lane in the stock market is each and every single week. And the goal here is to not get stuck in the stock market's traffic, which, with thousands and thousands of stocks can be very easy to do if you're picking wrong. So very excited about that. I think it's going to be your best option service yet. So very, very excited to roll that out. And readers, just keep an eye out this month. I think you're really going to like what you see. So let's get right to it, guys. Chad, let's start with you. So I know the last couple months, first of all, so what we do here is Chad likes to do kind of a more microscopic view of the market, highlighting a certain sector that's going to be breaking out based on his relative rotation graph. And then we kick it over to Mike, who does a little bit more big picture macro market stuff for us. So Chad, let's start with you. I know the last couple of months we have looked at energy and we looked at consumer discretionary. And I know you're probably going to do a review of those too, but I know you've also got a new sector that looks like it should be breaking out.
Yeah.
So what do you got for us this month?
Well, yeah, we'll do a quick review. Won't take too long today, but here's the relative rotation graph that I look at. And just a quick recap on the relative rotation graph. The center of this chart is the S&P 500. And then rotating around it are all the sector ETFs that make up the S&P 500. So it tells us where they are relative to the S&P 500. And then the top right leading, bottom right weakening, then lagging in the bottom left, and then improving in the top left. So as they rotate, and I can scroll back here just slowly and show you just kind of how, generally speaking, they rotate through these 4 quadrants in this, clockwise rotation. So this is what we're using to our benefit as we look at these sectors, where they're at on this chart, to figure out what sectors we want to jump into over the coming weeks. So last month, it was the consumer discretionary sector here in XLY that we wanted to jump into. But you can see how kind of since we jumped into it, once it got up into the improving, and then it started to weaken a little bit. I mean, it was in the leading quadrant, but it didn't continue up in kind of that northeast direction. Whereas when you look at energy here, and this was actually the sector that we were looking at 2 months ago, but last month I mentioned that it was still in a good spot. And then watch how it trades now in the leading, it takes off. So energy was really robust here over the past few weeks, which has been a pretty challenging time in the markets, volatile time. We're going through a correction right now, but energy is holding up nice. And I have just one stock that we talked about. This was from 2 months ago, but it was the XEC. So this was a stock that we recommended 2 months ago, didn't do too much, but then you can see it really took off here in September on about a 10%. No, this one was about a 30 or 40% rally just since we were looking at it. So it really just goes to show that these energy stocks started to take off. Some of the ones that we had recommended didn't see a move quite that big. But this is just one example of when you catch the sweet spot, and you can see here on the shaded charts, on the shaded candlesticks, where it was lagging here on the pullback in August, and then it improved and then went to the leading. And then that's the big run that we saw in the leading quadrant. So that was great to see. That's exactly why we follow this chart, the relative rotation graph. So from last month, real quick, the stocks that we were looking at, one was Active. So this one didn't do much. It's basically is down a little bit since September 1st. Was about right there. So it's down slightly. Didn't really do anything, just choppy. Another stock that we were looking at was Ford. That was a big one that I wanted us to keep an eye on. It popped up about 10% in September. So it had a nice move. And again, the overall market here was pretty volatile during this time frame, but Ford started to take off. Now it's pulling back a little bit. And then our other stock was CarMax, and this one shot up as well, about 10%. It looks like a much bigger move for this large stock. But I went from the 125 up to about 146, and then crashed on earnings just the other day. So a big pullback in the stock, and this is why we, once it gets into that leading quadrant, we look to take profits most of the time, especially on a short-term rotation like this that we're looking at.
You can't control earnings, but that relative rotation graph is no joke. So that move in, I think it was Cimarex you were showing us, XEC, took off just like it predicted. And you've been looking at a lot of auto stocks in the consumer discretionary. And
so
it looks like
nice to see those
pretty much what the RRG is designed to show us what they can do.
Yeah, so I mean that's exactly what we want to see. It's not going to work out like that every single time. And
no, of course not.
XEC, this was a big move, but CarMax, I mean, this is like what we're typically trying to look at. It's just kind of perfectly from the lagging quadrant where we get that turn, then improving, then leading. So it went through the whole motions here. Now for this month, the sector that we're going to be looking at over here on the chart is the utilities sector. That's the one that we're going to really put on our radar. But you can also see that the material sector is in a great spot to break out here as well. And then even as we look at the consumer staples, they kind of did this quick hook, and they're starting to go in the right direction that you would want to see. And same with healthcare. So those four sectors in general are the ones that you want to watch here over the coming weeks. When it comes to technology and then real estate, these are both still heading in this, southwest, deeper into the lagging quadrant. And so we want to wait for that turn before you really start to look to add positions and to take advantage of the rotation here. So that's why we're looking at utilities today. And then when we pull up the utilities chart, this one, instead of having the center be in the S&P 500, it's like we're breaking apart the utility sector. And now we're looking at the utility stocks rotating around the XLU, the utility sector ETF. So it's all relative to that sector because we're trying to get this kind of chain reaction where if utility stocks are starting to improve, relative to the S&P 500, then we want to find the ones that are going to improve the biggest relative to the utility sector itself. And then when we look at this chart, we're going to take basically the exact same model that we're doing with the bigger chart. We want to see them kind of in this lagging to improving quadrant and heading in that same northeast direction, making that turn to start to head higher and up towards improving. So that's why we're not going to mess with Entergy today, because it's still heading down pretty sharply, and this could last for days, for weeks, just like we see some of these once they go into the leading quadrant, they keep going for days or weeks, like the energy sector just did. Same thing with the lagging. So we don't want to mess with them while they're still falling. We wait for them to turn higher. And that's why the three stocks that we wanted to look at today are American Electric Power. These are stocks that you want to have on your radar for trying to make that same moves that we've been looking at. And then XL Energy. So XEL is the ticker for that one. And then Eversource Energy, ES. So American Electric Power was AEP, was the ticker for that one. And I just have over here, because when you pull up these charts, they're all going to look pretty similar to this. The utility sector got hammered here over the past, couple of weeks. So this was a sector that was taking a bit of a dive. And when we pull up something like the AEP, American Electric Power, see, it looks very similar. But once we break down the charts, relatively speaking, this is the one that we're expecting to turn higher sooner than the stocks that are still out here based on the relative rotation graph. So those are the three that we want to watch here in October.
In its lagging quadrant, while in the price chart, it looks like it's finding a base, it's finding a floor. Yeah,
they're starting to try to turn around. And another thing that was really interesting, I'll show you real quick. I think it was, so like this one. This is XL Energy. You can see it's in the improving quadrant over here, because this is relative to the utility sector ETF XLU, but over here it's still lagging because it's based on the S&P 500. So it's still lagging the overall market a little bit sharper, but we see it's already improving relative to the stocks within the utility sector. So that's kind of an early hint that it's going to be one of the ones that are going to help lead the way as the utility sector starts to improve from where it's at relative to the S&P 500. So a lot of relativity speaking, but that's really where your performance comes from. So we're looking for outperformers here. And those are the three stocks that I'm expecting to outperform through the month of October.
Very good. Yeah, and it definitely looks like from this price chart. So it's still red because it's relative to the S&P 500, but within its sector, it's clearly in the improving quadrant. Yes, and it looks like this one is definitely starting to bounce from its floor. You see two candlesticks, which kind of look like they formed a base there, and now it seems to be wanting to bounce higher. And we clearly saw from what happened in the auto stocks in consumer discretionary that hopefully these are going to follow the same course. Of course, we know we're not going to win on every single one. But Chad, I'm really impressed when you go back to the relative comparison of all the sectors of what happened with energy. So this was in our first monthly outlook in August. That was your pick for the breakout sector. And it was right about there, and it didn't make a whole lot of movement in August, but then in September it absolutely went bananas.
Yeah, this is the rotation from, so that was early August. It was up there. The problem is that it peaked early on after that and then fell down. And then this was early September when we were looking at it. So this was when we were saying that it was another opportunity to keep the energy sector on your buy list, on your radar here, going into the month of September. And then that's the one that really helped it send higher from there, through the month of September.
And I think this is so interesting because obviously it dipped a little bit because we had this Delta fear a little bit, and people have nerves about maybe a second shutdown or something. And now those fears have basically been washed away. I mean, I know here in Florida, we've seen an absolute crash in cases, which is amazing news, but this just shows you can't fight the trend. And this is why we care about technicals so much more than news and fundamentals and all that stuff, because we see what happened. Yes, there was a short-term news cycle, but it ultimately did not affect this trend at all, which I think just speaks volumes about your methodology.
Yeah. I mean, the news is always the news. There's always something that ties back in or gives you a reason to sell and panic. But at the end of the day, price is really what matters, especially to me. I know everybody's got their own trading strategies, but I follow the price because that's where we're going to calculate our returns from. So at the end of the day, as long as it's going up, we can still make money.
I like your approach because it's simple and I don't like to work very hard. So keep doing what you're doing, Chad. It's great to see. And you just saw when you scrolled back to maybe July or August, XLE was clearly in lagging. And this is why we do what we do. We wait to see it start to turn up, and then ideally it follows that course. And so here we see it going from Southwest all the way up to Northeast, which it's very cool. Obviously, not every example will always be this clean, but it's a great example of why we love the RRG so much.
Yep. Thanks, Chris.
Cool. All righty.
I'll stop.
Thanks for that, Chad. So, Chad, do we still want to look out for any good movement in consumer discretionary, or should we just stay focused on utilities?
Yeah, you want to stay focused on utilities right now. Consumer discretionary is actually looking more to the downside, because the same way that we look on the bullish side, that's mainly because we're bullish, right? I'm bullish right now on the market, but on the flip side of that, once they get into the leading quadrant and start to turn lower, kind of where the consumer discretionary sector was, that's when you can start to make some plays to the downside. Like we saw the stocks in CarMax make a big dip. So there's a few other opportunities in that sector, probably on the downside here over the next couple of weeks.
Gotcha. Okie dokie. Well, let's kick it over to our macro specialist, Mr. Mike Carr. Now, Mike, you threw a bit of a bombshell at us last month. You didn't have a monthly outlook. You had a 3-year outlook predicting S&P 500 is going to more than double. That we're basically entering into a, what do we call this? A melt up, a crash boom. What do we call this thing?
Exactly. I still think we're on track for that, and I have some charts to show that. But I want to start with the chart here that highlights what Chad was talking about. This is a chart of the yield on 10-year treasuries. And it really shot up here in the past month. Chad highlighted that real estate is now one of the real laggards, and interest rates moving up, that's going to hurt real estate. Because if you buy real estate, you're almost always leveraged. So the interest rate is one of the most important factors determining whether or not you're going to profit in your investment on real estate. Seeing the real estate sector lagging, like Chad just shows, reinforces my opinion that interest rates are moving up and they're going to stay up. So we saw this big jump, and we're at 1.54% on the 10-year. The Fed's favorite measure of inflation came out today, personal consumption expenditures, less food and energy. It's up 3.6%. So if you buy a 10-year bond here at 1.5, inflation stays where it is, you're losing 2% a year. Investors aren't going to put up with that for long. Interest rates are going to move up. And we see this big jump. What I found interesting looking at the chart was that pullback that we saw. So interest rates were rising from last August all the way up into March of this year. Then there was a pullback. This is a Fibonacci retracement level right here at 127. We dipped below it a little bit, but came back up above it. We were below it quite a while for traders, about 3 weeks. And after 3 weeks, traders like believing the long-term trend is reversed, but it didn't. It was just a Fibonacci retracement. We're now headed up. This is the fastest increase we've seen in quite a while. This is the 10-day rate of change, up almost 20% in just 10 days. We have seen similar moves like this way back at the beginning of the year when rates moved from 1.2 to 1.7. We also saw it back here in August as rates were preparing to move from about 0.5 to 1.7. So we should expect rates to break 1.7, maybe move above 2%. And once rates get above 2% on the 10-year, I think they're going to stay there. The Fed has said they want 2% inflation. It makes no sense to own a 10-year below 2% because you're going to lose buying power. And it just can't last forever. So I think we're seeing the end of this historic low interest rate. I was really surprised to see Chad mention real estate where he did, because that kind of reinforces that opinion.
So, Mike, what do you think is going to be the catalyst that's going to send them up to 2%? I mean, I certainly understand investors aren't going to be willing to buy a 10-year at where things are right now because inflation has just been roaring lately. But what do you think is going to be the driver there? So
I think the driver is going to be a very technical catalyst here. Congress does not have their act together. And that's not a political statement as much as a reality. We saw yesterday, all day long, news was focused on Capitol Hill, and at the end of the day, nothing happened. We're facing that same kind of scenario with the debt limit. And if the Congress can't raise the debt ceiling, there's the possibility of a default in the bond market. Now, nobody's really going to lose money on that. The government will pay all the interest they owe. But if that default occurs when futures are being settled, you're going to see a spike in bond prices, and you're going to see just panic develop in the market. So when futures markets reach expiration, somebody has to deliver what they bought. So if you're long gold, for example, and your contract expires, you owe someone, if you owe someone 1,000 ounces of gold and you have to deliver it. Now, gold, we can understand, that's tangible. Bonds are the same. If you're holding a bond contract and you have to deliver, you've got to come up with $100,000 worth of 10-year treasuries. If the government's not issuing treasuries, if you have to get that specific treasury, you're going to pay whatever you have to because that's the way the market works. Once that risk is introduced and everyone sees that this is a long-term dynamic, Congress is not functional, you're going to face this risk with the debt ceiling, which Congress is unable to get a long-term fix for. Interest rates are going to have to be higher so that bond traders can afford this risk when it unfolds every year or so. So it's a very technical thing about delivery, but I think that's going to put fear into bond traders. And bond traders are never going to again accept 0.5 on a 10-year when they face the risk of having to go out and spend a 10% premium to get the bond they need to deliver at expiration. I know that was way too technical.
No. Like we say, we love the technicals. It's all that matters. Mike, it kind of looks like this chart is almost correlating with investors' appetite for risk. So we've seen a lot of sideways movement, and I know the Russell 2000 in particular, small cap stocks this year. I know some of our experts who focus on growth stocks have had a bit of a challenging year for this reason. And so we just saw this huge movement from, looks like summer of last year into February, March. And now it looks like it's taking off again, which I think we're also seeing in a lot of speculative investments. So do you think that yields right here on the 10-year Treasury might be paralleling some more risk on parts of the stock market?
I think that's a great insight, and that is true. And to answer that, I'm going to create a chart comparing Treasury yields to corporate yields, and I will answer that in 500 words or more on Tuesday in Tom. So I think the best way to do that would be to show, because that's a risk on, risk off indicator. It's Treasury yields and you're comparing corporate yields to it, and it precisely measures risk appetite. And I can explain all that without getting too technical here. We're recording this Friday. I think it's out for viewing on Monday, so that article will be out on Tuesday.
Very good. Okay. Mike, I'm getting quite a bit of rain here in South Florida. Chad, how's your weather? Just want to make sure we don't get interrupted.
Yeah, I won't be interrupted, but I can't even see outside in here. Got the blinds and curtains all pulled up.
Fair enough. Well, Mike, do you have any other charts to show us, or were you just planning on showing us the 10-year yield today?
I'd like to show a few more charts if I can.
You absolutely can.
This is the S&P 500 ETF, SPY. And last month I talked about that 50-day moving average and how important it was. We broke below it. That created kind of a panic on CNBC and in the pundit community because we're below it. But remember, we just looked at that 10-year chart, And the important level there was that fib retracement right at 38.2%. We broke below it. We stayed below it about 3 weeks, but now we're back in that uptrend. And I think we're going to see the same thing here. I think we may be below the 50-day for a couple of weeks, but we're not at a point where it's a panic-inducing breakthrough just yet. We have, this is my peak velocity timing tool. It's a momentum indicator. And we see a bullish divergence. We see a lower low in price, a higher low in the indicator. That's a bullish divergence. That really tells me that this break is going to be resolved. It's kind of a bear trap here. It's sucking people in. It's getting them to believe that the market's going lower, but I believe it's still a pullback. We're at about a 5% pullback. I don't think we're going to see a 10% pullback here. So we're near the bottom. Momentum telling me this is a short-term dip below that moving average.
And that's because based on your timing, your peak velocity timing tool here, Mike, just to explain that again, because it looks like it's heading lower right now.
Well, it's divergence because here when price was at about 434, the timing tool was way down here.
Okay.
And now with price at about 430, we have a higher level on it.
Gotcha. A higher low. Okay,
yeah,
so that is interesting. So prices have continued to drop. However, the timing tool is showing an uptrend. I
correct.
So now the divergence is clear. Okay.
Yeah, I should have had those little lines at first, but
no, it's clear now. So that is very telling. So you think that we are probably close to a bottom here. And
correct.
Yeah, I think it's probably a good idea to keep an eye on that line in price that you just showed. It could dip a little bit lower, but it's probably going to tread that line.
Right. I think it was Ben Graham who said the market's primary job is to confound as many people as possible. And, this is really the tone of the coverage has shifted so dramatically in the past few weeks to the world is ending. And I don't think the world is really ending this time. I think, in January 2020, the media coverage was largely telling us, don't worry, be happy. And at that point, the world was kind of ending as we knew it. In early February 2020, politicians were crowding into mass transit for the first time in years, telling us the coronavirus isn't a big deal, it's isolated, you should be out there supporting local businesses. This time, when we don't really have a big crisis that's going to force us all into our homes for 15 months, the coverage is dramatically different, with everyone warning us that if Congress doesn't spend $3.5 trillion this day, the world is going to end. So I think momentum is telling us more right now than the news coverage, which has gotten so bearish. We're seeing some sentiment measures, AAII, investor sentiment, really taking a bearish turn, as I talk about in my market intel report the last few weeks. A bearish turn equivalent to what we saw in 1996 as that melt up was beginning back then. So I'm seeing a lot of alignment with that 96 pullback that launched the melt up. I'm also continuing to see the Fed pump money in to the economy at a phenomenal rate. In the last quarter, the growth rate of M2, which is a broad measure of money supply, more than 13% in 13 weeks. The Fed is increasing the money supply an average of 1% a week. And that's just phenomenal. The blue lines here indicate times when the Fed is supportive of higher stock prices, and we're really seeing that play out. This is another way to look at the Fed. This quantifies their quantitative easing. And it shows the amount of Treasury sitting within the bank channels waiting to go to the Fed through a QE program. Green lines showing when banks are just raising cash and looking for a reason to basically loan money. And that's what we're seeing here is banks really stockpiling their cash, getting ready to make a lot of loans. And in the past, this has been supportive of higher stock prices. So that's all the charts I wanted to cover. I know maybe a little technical here too, but lots of reasons to expect more gains.
Well, yeah, I'm just looking at periods where the green line is as wide as it is now. So we're looking at, the 2003 or so there. What
right.
happened?
This was October 2002.
Bear market bottomed out. And then what happened? Stocks took off. We see it in the early 90s. Stocks took off. Looks like we see it in the early to mid 80s. Stocks took off. So I certainly see what you're saying here.
Yeah, this is what's nice about this is we have such a long period of time in data on how many treasuries banks are holding. And, we see going back to when Eisenhower was president, this has consistently spotted important market rallies. Some misses, but for the most part, this has really been supportive of a melt up scenario.
All righty. Well, is that all you had for us today, Mr. Carr?
That was it. Thank you.
Well, something else I wanted to talk to you about, Mike, is today on Friday, is when we're recording this, you released an article in Tom, and you've been teasing a strategy you're working on based on how you managed, I think, over $200 million about a decade ago, and based on strength. And you released the first couple of trade recommendations for free in True Options Masters. I think you're bullish on lithium, and there was one other one.
Yeah, it's a lithium ETF and then the ETF for Argentina.
Argentina, interesting.
And they're technical trades. There's lots of reasons to worry about lithium. Is it in a bubble? And we're not going to worry about that. This strategy just says if it's going up, buy it. And there's quantified rules to describe all that I'll be detailing in the coming weeks. We'll get into more of the rules next Friday because I've already promised to write about something for next Tuesday. And we'll just explain the whole rationale. And we're also going to explain, some of the constraints as a money manager, why we used ETFs, why we did different things to really help you understand things your financial advisor might not tell you and might not want you to know about.
Well, I'll be looking out for some more of those rules, Mike. It is interesting how, the conventional wisdom is you want to buy when something's bottoming out, but you don't do that. You buy things that are showing peak velocity. You buy high and you sell even higher, which I think is a great twist on the conventional wisdom. So I'm once we finish this call, I'm gonna log into my Robinhood brokerage account, which I know you hate, but I gave them a hard time this Wednesday, just for you, Mike. I'm gonna log into my broker. I'm gonna look at a few different things here. I'm going to look at utilities. I'm going to be looking at lithium. I'm going to be looking at Argentina just because Mike Carr told me to. So I'll be looking for some maybe trades that I'll be adding. So look for some strength there. So, all right, guys. Well, this was a great call. We'll keep an eye on utilities this month, and we'll be looking for an uptrend in the stock market. Looks like that'll be bottoming out. So appreciate y'all's time, and thank you to all of our readers. Again, if you like this video, please like, comment, subscribe to our YouTube channel. We'll be back next month with another monthly market update, reviewing the claims that were made today. And in the meantime, keep checking your emails. A lot of great content coming your way. This upcoming Wednesday, I'm going to be looking at a trend I've been noticing, not a trend so much, but I studied a little bit of psychology when I was in college, and I've always been a very big fan of personality tests and the Myers-Briggs. And I asked our two gentlemen master traders here to take the test a little earlier, and I noticed that they have nearly identical personalities. I don't know if you could tell that from listening to them speak or the fact that they're both rules-based traders. But I'm going to be talking to you about how you can figure out what kind of trader you are this upcoming Wednesday using personality profiles and a little bit of psychology. So lots of great content coming your way. Keep opening those emails. We appreciate your engagement. Tom this year has been killing it, and it's got us very engaged and very happy to be doing what we're doing. So until next time,